Hello friends, how are you doing? I hope the market's treating you well and you're able to make good profits from the markets, and my videos are helping you become better traders. That's what this channel is for, to put you ahead with cutting edge tools and studies which I share with you, which you will not find anywhere else in the public domain. Jumping quickly right in, on your screen now is the market roundup which shows that the markets ended with overall gains because of the risk on sentiment. Now, traders were open to the idea of taking higher amount of risk, which is seen from the fact that the only losers were safe haven investments like gold and silver. All the other financial assets rose in spite of the fact that oil and gas were up, and the Dixie and the USD INR were also higher. The Nifty managed to outperform the Bank Nifty, and even though the Dixie rose marginally, the USD INR rose higher in relative comparison, which makes the INR, the rupee, under pressure in the absolute near term. Now, this needs watching in the coming week. Right now, nothing big to worry about, but if this trend continues, you need to be careful out there. Coming up on your screen is the MWPL, or the market wide position limit chart of the entire market, which shows traders continue to ramp up exposure, which is routine after an expiry, because on expiry day, open interest falls very drastically and continues to go up till the third week into the new derivative cycle. Now on your screen is the stock and index futures volumes chart. Do remember, this is a cumulative study, which means it includes futures of June, July and August series. It shows a decline in stock and index futures on a week-on-week basis, which means the rally which you saw last week in the market was on lower volumes, which is a mild concern because the rally should have ideally come on higher volumes. It tells me that traders were a little skeptical or a little cautious in participating at higher levels. This is another aspect in addition to the USD INR, which you will need to watch in the coming week. Now let's go to the basis chart. The basis is nothing but the premium of the futures over the spot, and it shows basis on both indices expanded on a week-on-week basis because traders were willing to pay a higher premium to go long. The longer tenure left to expiry helped matters, which is another routine phenomena after expiry. The basis tends to flatten out over a period of time. Now let's take a look at the impetus chart. Now this is a new study which I added and shared with you about a month and a half or so. Now the impetus chart on your screen shows that the Bank Nifty in relative comparison with the Nifty 50 was easing lower on a week-on-week basis, and it reflects on the Bank Nifty's price, which was muted compared to the Nifty. Now the Nifty's impetus is relatively better, which makes this index a better option of the two to watch out for next week. Now these studies are in-house and you won't be seeing them anywhere else. Now let's take a look at the exposure footprint of the three types of traders: the FIIs, the prop traders and the retail guys. On your screen is the FII footprint of net positions, long minus short in index and stock futures. It shows the FIIs continued to wind down the index and stock futures exposure. On the other hand, the chart of the prop traders shows that prop traders cut their index shorts but continued to raise their stock futures exposure. Now, the most interesting chart of the three is the retail traders. What are these guys doing? The retail traders continue to do all the heavy lifting. Where exposure on stock futures are concerned, note how the stock futures exposure is approximately 6 times, you heard that right, 6 times bigger than FIIs and prop traders put together. Now, this is extremely heavy concentration in one segment of the market, which means it's the retail guys who are pushing the indices higher. This calls for the possibility of higher volatility because some guys can get shaken out even on the smallest possible decline. The retail, of course, continued to be sanguine on their stock futures, which they have been cutting as in when the indices fall. That done, let's take a look at the bond markets. The 10-year benchmark bond yields rose by 2 basis points on a week-on-week basis. And the noteworthy event for bond investors was that the RBI kept interest rates unchanged in their announcement on the 4th and talked of continued monitoring of the yields and keeping the yields in the vicinity of 6%. Now, I would suggest you keep watching the bond yields on a day-on-day basis because this will have a direct impact on the Bank Nifty for those guys who are Bank Nifty traders as well as individual stock futures traders as well. Friends, let's now go to the US dollar index, also known as the Dixie. The US currency benchmark, as you can see on your screen in the chart, rose on 3 out of 5 trading sessions and attempted to rally past its 25-day exponential moving average, but it failed. The 89.5 level will act as a near-term support to watch out for. Should this index rally, it can cause the emerging markets to witness some pressure. Emerging markets tend to be import dependent and therefore a rising dollar hurts their balance of payments. Now coming up on your screen is the weekly chart, which shows 2 consecutive long leg doji candles on the weekly chart. This could be an early warning of a bottoming out formation subject to follow-up buying action. The price remains below its 25-week exponential moving average, which means the downward pressure is not over yet. A rally past the 91.5 level will be required before a breakout can be confirmed. Last week, I advocated a range between 91.50 on the upside and 89 on the downside, which held perfectly well. The coming week is likely to see an estimated, I stress upon the word estimated, range between 91.15 on the upside and 89.10 on the downside. Friends, now let's go to the Bank Nifty, which rose on 3 out of 5 trading sessions but closed with small gains on a week-on-week basis. The price, as you can see on the chart, remains above its 25-day exponential moving average, which means the short-term outlook also seems optimistic as long as the follow-up buying persists. Staying above the 34,500 marks remains a critical precondition to further up moves. Now let's switch to the weekly chart on screen, which shows an inverted hammer. Because the bulls did manage to push the index higher on a week-on-week basis but couldn't sustain prices at higher levels. The price remains comfortable above the 25-week exponential moving average, which means the medium-term outlook remains optimistic. In the week before last, this index was at number 3 on the most volatile counters list, but it fell to number 4 last week because beta fell due to smaller intraday ranges. Last week, I advocated a range between 36,900 on the upside and 33,400 on the downside, which held perfectly. The coming week may see an estimated, I stress upon the word estimated, range between 36,950 on the upside and 33,625 on the downside. Ideally, the index should stay above 35,800 to stay bullish. Now, this 35,800 is the previous week's high. As long as the bulls manage to keep the index above this, I think the short sellers will remain on the back foot. Friends, let's now go to the Nifty. This index is the most liquid and low impact cost counter to trade on the NSE. It rose on 3 out of 5 trading sessions and went past the previous all-time high of February. Do note how in the last week's video, I said the real all-time high will actually come between 15,600 to 15,700, because you need to add the cost of carry for 4 months, that is Feb to March, March to April, April to May, and May to June, to the previous all-time high of 15,400 odd, because the bulls would have paid that much to carry their longs over. And the Nifty indeed ran into resistance at 15,733 along expected lines of 15,700. The index stayed above its 25-day exponential moving average, which means the short-term outlook remains positive for now. Watch the weekly chart on your screen, which shows a sustained breakout above the bearish channel, which can become a flag formation in the making if the bulls provide follow-up buying support. The price, as you can see, remains above its 25-week exponential moving average, which makes the medium-term outlook remain positive. In the week before last, this index was at number 8 of the most volatile list, but last week it rose to number 7 due to the higher beta or volatility seen. And last week, I indicated a range between 15,925 on the upside and 14,950 on the downside, which held perfectly even through all the volatility. In the coming week, I expect a range, estimated range between 16,125 on the upside and 15,200 on the downside. Now the beta or volatility may continue to rise, so I would say you should please continue to trade cautiously. The tide for now favors the bulls, and follow-up buying will be a critical aspect to watch out for, failing which there is a possibility of a correction. But this would be along expected lines. Do remain glued on and connect with me on social media, where I put in a lot of stuff at the end of the day after market hours, which will help you monitor this situation on a day-on-day basis. Friends, I now come to the most popular segment of my video, wherein I give you 5 high beta, high impetus stocks, wherein you take small exposure, wait for big price moves, and exit profitably. Now, the high beta, high impetus stocks are led by Adani Enterprises. Number 1, no prizes for guessing, has been making tracks and burning the tracks rather. Number 2, Muthoot Finance. Number 3, LIC Housing Finance. Number 4, Voltas. And number 5, Adani Ports. Now here come 5 low beta, low impetus stocks where you take larger exposure, wait for small price moves to make your money. Number 1, Pidilite Industries. Number 2, BPCL. Number 3, Tata Steel. Number 4, Jindal Steel. And number 5, ICICI Bank. Friends, do note that the hierarchy of this low beta and high beta stocks can change on a day-on-day basis, because price action will witness a change in volatility parameters. So connect with me on social media. My contact coordinates come at the end of this video, wherein I update all this critical stuff on a day-on-day basis. Friends, I now bid goodbye to you in this video, not before reminding you to click like on this video and subscribe to my YouTube channel if you haven't already done so. Click on the bell icon to receive alerts about fresh videos being put up out here in the comments section. Do let me know how my videos are helping you become better traders. And help me reach out to like-minded investors by referring my videos to your family and friends if you like my videos. Also, below the video in the description segment, I have enclosed hyperlinks to Equity Master's YouTube channel and how you can receive a free trading guide, my free trading guide from Equity Master. Both the links are enclosed in the description. The Equity Master's YouTube channel contains a whole lot more videos which I put up out there at the rate of 4 videos a week. Do sign up for that channel as well. I wish you have a very, very profitable day, my friends. Take very good care of your trades and investment, family, friends, and health. Vijay Bambani signing off for now. Thank you for watching. Take care. Bye-bye.